Fix Your Credit in 2026, the complete step-by-step credit repair documentary. Your credit score is not a measurement of your intelligence, character, work ethic, or value as a human being. It is a mathematical estimate of how likely you appear to repay borrowed money. Yet this three-digit number can influence where you live, what you drive, how much interest you pay, and whether a financial emergency becomes manageable or devastating. Two people can purchase the same car on the same day for the same advertised price and still pay dramatically different amounts. The person with stronger credit may receive a lower interest rate, smaller payment, and lower total borrowing cost. The person with damaged credit may pay thousands more. That is why repairing credit is not simply about chasing points. It is about reducing the price you pay to use money. The good news is that credit is not permanent. A low score is a snapshot created from the information being reported at that moment. When the information changes, the score can change. Errors can be corrected. Credit card balances can be reduced. Past due accounts can be brought current. New positive history can be established. Negative information can become less influential as it ages. But credit cannot legally or reliably be repaired with secret numbers, fake identities, mass disputes, or overnight loopholes. Real credit repair comes from accurate reporting, consistent payments, controlled balances, careful account management, and time. Before fixing your credit, you must understand the difference between a credit report and a credit score. A credit report is the underlying record. It contains accounts, balances, payment histories, inquiries, collections, and certain public record information. A credit score is a number calculated from information contained in that report. The three nationwide credit reporting companies are Equifax, Experian, and TransUnion. Because creditors do not always report to all three companies, your reports may not be identical. If one report contains a collection that the others do not, scores calculated from that report may be different. You also do not have only one credit score. You can have many scores at the same time. FICO and VantageScore produce different scoring models, and each company has released multiple versions. Mortgage, automobile, and credit card lenders may use industry-specific models. The score displayed by a free app can therefore be legitimate while still being different from the score a lender obtains. Most commonly used consumer scores operate on a range from 300 to 850, although some specialized models use different ranges. A higher number generally represents lower perceived lending risk, but no score guarantees approval. Lenders can also consider income, employment, debt obligations, available cash, collateral, and the type of loan requested. Income is not normally part of a traditional credit score. Your bank balance is not normally part of it either. Debt-to-income ratio can strongly affect a lending decision, but it is different from a credit score. Someone can have a strong score and insufficient income for a particular loan. Another person can earn a large income while having damaged credit from missed payments. The widely used FICO scoring framework generally assigns approximately 35% of its calculation to payment history, 30% to amounts owed, 15% to the length of credit history, 10% to new credit, and 10% to credit mix. These percentages describe the general model. They are not a promise that one action will produce a specific number of points for every person. Payment history receives the most weight because lenders want to know whether previous obligations were paid as agreed. Amounts owed include credit card utilization and the remaining balances on loans. Length of history considers factors such as the ages of your oldest, newest, and average accounts. New credit includes recent applications and recently opened accounts. Credit mix considers experience managing revolving accounts and installment loans. You do not need to master every mathematical detail before taking action. You need to identify which parts of your profile are producing the greatest risk. The first step is obtaining all three credit reports. In 2026, consumers can obtain free weekly online reports through annualcreditreport.com, the website authorized by federal law. Requesting your own report does not lower your score because it is considered a soft inquiry. Do not assume that checking only one report is enough. Download Equifax, Experian, and TransUnion. Save a dated copy of each report so you have a baseline. If information changes later, you will be able to compare the original report with the updated version. Begin with the personal information section. Review your name, variations of your name, addresses, employers, and identifying information. An old address usually does not lower a score by itself, but an address you have never used can signal a mixed file or identity theft. Next, create a complete account inventory. For every account, record the creditor, account type, reported balance, credit limit, payment status, date opened, last reported date, and any late payment notation. Compare the same account across all 3 reports. Look for accounts that do not belong to you, duplicate collections, incorrect balances, payments marked late when they were made on time, closed accounts shown as open, accounts incorrectly marked as charged off, and credit limits reported incorrectly. Check whether an authorized user account has been confused with an individual account. Examine every late payment notation. Credit reports normally categorize late payments according to whether they were 30, 60, 90, or more days past due. A payment can generate a late fee before it becomes 30 days late, but creditors generally do not report a standard delinquency to the nationwide bureaus until the payment reaches at least 30 days past due. Review collections and charge-offs carefully. Confirm the name of the original creditor, the collector, the balance, and the date the delinquency began. A debt being sold from one collection company to another does not create a new 7-year reporting period. In general, the reporting period is connected to the original delinquency that led to the collection or charge-off. Review hard inquiries as well. A hard inquiry is normally created when you apply for credit and authorize a lender to check your report. A soft inquiry can result from checking your own credit, account monitoring, promotional screening, or certain employment reviews. Soft inquiries do not affect consumer credit scores. Do not dispute correct information simply because it is negative. A legitimate dispute identifies a specific factual error and includes evidence supporting the requested correction. Filing false disputes can delay genuine corrections and may cause future disputes to be treated as frivolous. For every suspected error, write down exactly what is wrong. Do not write only that the account is inaccurate. State that the reported balance is incorrect, the payment was not late, the account does not belong to you, the collection is duplicated, or the account is too old to remain. Gather supporting records. Useful evidence can include account statements, payment confirmations, canceled checks, bank statements, settlement letters, identity theft reports, court records, and correspondence from the creditor. Send copies and retain the originals. Dispute an error with both the credit reporting company and the company that furnished the information. This might be a bank, card issuer, loan servicer, or collection agency. Correcting the information at both levels reduces the risk of the same error being reported again. A strong dispute letter identifies you, identifies the account, explains the precise error, states the correction you want, and lists the enclosed evidence. Keep the language factual. Emotional explanations are less effective than a clear record demonstrating what happened. Online disputes can be convenient and fast. Written disputes sent with trackable delivery can provide a stronger paper trail when an issue is complicated. Whichever method you use, save the confirmation number, submission date, evidence, correspondence, and investigation result. Credit reporting companies generally have 30 days to investigate. In some circumstances, the investigation may take up to 45 days. After completing the investigation, the company generally has 5 business days to notify you of the result. If the information is corrected, obtain fresh reports and verify the change across every bureau where the error appeared. Do not assume that a correction at one bureau automatically changes the other 2. If an item is verified but you still have documentation proving it is wrong, review the investigation result carefully. Send additional evidence to the bureau and furnisher. If you have completed the required dispute process and the problem remains, submit a complaint to the Consumer Financial Protection Bureau. You may also consult a consumer law attorney, especially if the reporting error is causing a loan denial, housing problem, or financial loss. Accurate negative information normally cannot be forced off a report simply because it is damaging. Most negative account information can generally remain for approximately 7 years. Bankruptcy information can remain for as long as 10 years, depending on the type and reporting circumstances. Paying a collection does not restart the federal credit reporting period. However, the time a collector has to sue is controlled by state law and is a separate issue. In some states, making a payment or acknowledging an old debt can restart the statute of limitations. Before making a payment on an old debt, verify ownership, the balance, the age of the debt, and the law that applies where you live. Identity theft requires a different approach from an ordinary reporting error. If an account was opened without your permission, report the identity theft through identitytheft.gov and follow the recovery plan. Contact each affected creditor, preserve evidence, change compromised passwords, and review other financial accounts. Place a credit freeze separately with Equifax, Experian, and TransUnion. A freeze is free, does not lower your credit score, and restricts access to your report by many potential new creditors. You can temporarily lift the freeze when you legitimately apply for credit. A fraud alert is another tool. An initial fraud alert generally lasts 1 year and tells businesses to take additional steps to verify your identity. An extended alert can last 7 years for qualifying identity theft victims. Unlike a freeze, placing an alert with one nationwide bureau generally requires that bureau to notify the other two. Once your reports are accurate and secure, focus on payment history. If every account is current, keep it that way. If accounts are past due, preventing additional late payments becomes the immediate priority. List every required monthly payment, its due date, the minimum amount, and the account used to pay it. Set calendar reminders several days before each due date. Whenever possible, activate automatic payment for at least the minimum required amount. You can make additional manual payments, but the automatic minimum serves as protection against an accidental missed payment. Autopay is not completely automatic. You must still verify that the payment account has enough money, the transaction was processed, and the creditor applied it correctly. An expired card, changed bank account, or failed transfer can still create a late payment. If due dates are concentrated around one paycheck, ask creditors whether they can move those dates. Many card issuers allow customers to select a more manageable due date. Organizing payments around income can reduce accidental delinquencies without changing the amount owed. If you believe you may miss a payment, contact the creditor before the account becomes delinquent. Ask about hardship plans, temporary reduced payments, due date changes, interest reductions, or payment arrangements. Get every agreement in writing and ask how the account will be reported. If you are already behind, ask what amount is required to bring the account current. A payment smaller than the past due amount may reduce the balance without curing the delinquency. Make sure you understand the status the creditor will report after each payment. An isolated, accurate late payment can sometimes be addressed with a goodwill request. Explain the circumstances briefly, demonstrate that the account is now current, and ask whether the creditor is willing to remove the late notation as a courtesy. Creditors are not legally required to grant goodwill requests, and no company can guarantee that one will work. Payment history improves through repetition. One on-time payment is helpful, but a sustained pattern is stronger. Every month that passes without a new delinquency adds current positive information and places more distance between today and older mistakes. The next major target is revolving credit utilization. Utilization measures how much of your available revolving credit is being reported as used. If a card reports a balance of $2,400 against a $3,000 limit, that card is 80% utilized. If the reported balance falls to $900, utilization becomes 30%. At $300, it becomes 10%. Scoring models can consider utilization on each individual card and across all revolving cards combined. A single maxed-out card can create risk even when total utilization across all cards looks moderate. 30% is often described as a target, but it is not a magical dividing line. Lower utilization is generally better for scoring, provided accounts remain open and active. Someone preparing for a major credit application may aim to have card balances report below 30%, then below 10% if financially possible. Never borrow money solely to manufacture utilization. The best balance is a balance you can afford to repay. Carrying a balance from month to month is not required to build credit. Interest does not purchase credit score points. The balance displayed on a credit report is commonly the balance the issuer reported around the statement closing date, although reporting practices vary. This creates one of the most useful legitimate optimization strategies. Paying down a card before its reporting or statement date can cause a lower balance to appear on the report. The statement date and payment due date perform different functions. Paying before the reporting date can reduce reported utilization. Paying the full statement balance by the due date can prevent interest on purchases when the account has a grace period. If possible, do both. Suppose you spend $1,500 during the month on a card with a $2,000 limit, and then pay the statement balance in full by the due date. You may avoid interest, but the report could temporarily show 75% utilization if the issuer reported before your payment. Making an early payment before the statement closes could lower the reported balance. This does not mean you must obsess over your score every week. Reporting date management is most useful when preparing for an important application or when a high reported balance is suppressing an otherwise healthy profile. If you have several cards, choose your payoff strategy according to your immediate objective. To reduce interest most efficiently, direct extra money toward the highest annual percentage rate while making minimum payments on every other account. This is commonly called the debt avalanche. If your immediate goal is scoring improvement before a loan application, reducing cards with the highest individual utilization may produce a faster improvement in the risk displayed by your reports. This does not guarantee a particular score increase, but it addresses the revolving balances scoring models evaluate. A credit limit increase can also reduce utilization if spending remains unchanged. Before requesting one, ask whether the issuer will conduct a hard inquiry. Do not request an increase if a larger limit would encourage additional spending. Avoid automatically closing an old card after paying it off. Closing the account can remove its limit from your available revolving credit and increase total utilization. A closed account in good standing can remain on a report for years, but losing the limit can still create an immediate utilization change. Keeping an old no-fee card open may support utilization and account age. Use it occasionally for a small purchase and pay it in full if the issuer requires activity to keep it open. However, a card with a costly annual fee, poor terms, or serious temptation to overspend may not be worth keeping solely for a possible score benefit. Do not open several new cards just to create more available credit. Each application can create a hard inquiry. Every new account can reduce average account age, and additional limits can encourage debt. One carefully chosen account is more useful than 5 unnecessary accounts. If you have no active revolving credit, consider a secured credit card. A secured card normally requires a refundable deposit that establishes the limit. Choose a card that reports payment history to all 3 nationwide bureaus, has reasonable fees, and offers a path to graduate to an unsecured account. Use a secured card for one predictable purchase, keep the balance low, and pay on time. The deposit does not make missed payments harmless. A secured card is still a real credit account. Compare fees, interest, reporting practices, and cancellation terms before accepting a credit builder loan. You do not need to pay excessive interest merely to add an installment account. Credit mix is a relatively small scoring category and never justifies an unaffordable loan. Prepaid cards and ordinary debit cards generally do not establish traditional credit history because they do not involve borrowing. Some products advertise alternative reporting features, but you must confirm which bureau receives the information and which scoring models use it. Authorized user status is not guaranteed to improve a score. If the primary account develops a high balance or late payment, it can become harmful. Lenders can also distinguish an authorized user account from an account you manage yourself. The strongest long-term file includes credit held in your own name. Buying access to a stranger's authorized user account, commonly called purchasing a trade line, carries significant risk. Scoring models and lenders may discount suspicious arrangements. Sharing personal information with an unknown company can expose you to fraud. Build authentic credit instead of renting someone else's history. Some services allow consumers to add eligible utility, telephone, banking, or rental information to a particular report or scoring product. These services may help certain scores, but lenders do not all use the same bureau or model. Treat alternative data as a possible supplement, not a replacement for traditional on-time credit history. Collections deserve careful handling. Start by confirming that the collector has the correct person, amount, original creditor, and authority to collect. Review written collection notices and preserve every communication. Federal debt collection law gives consumers important validation and dispute rights. If you dispute certain collection information in writing within the period stated in the validation notice, The collector generally must pause collection of the disputed amount until it provides verification. State laws may provide additional protections. If the collection is valid, decide whether to pay in full, negotiate a settlement, or establish a written plan. Never provide electronic access to your bank account without understanding the authorization. Obtain settlement terms in writing before sending money and retain proof after the payment clears. Some collectors may agree to request deletion of a collection account in exchange for payment. This is known as pay for delete. It is not guaranteed, not every collector permits it, and deleting a collection does not automatically remove a separate charge-off reported by the original creditor. Never rely on a verbal pay for delete promise. If a collector offers one, obtain the agreement in writing before paying. Even with deletion, no one can truthfully guarantee a specific score increase. Paying a collection can still be financially valuable when deletion is unavailable. A paid balance can improve how a lender manually evaluates your file, eliminate collection activity, and satisfy underwriting requirements. Newer FICO models, including FICO 9 and the FICO 10 suite, generally disregard paid third-party collections, while older models may continue considering them. This is why someone can pay a collection and see no immediate score increase. The result depends on the scoring model, other information in the file, and how the account is updated. Paying a debt and improving a score are related goals, but they are not always the same event. A charge-off means the creditor classified the account as a loss for accounting purposes. It does not automatically erase the obligation. The original creditor may continue collecting or sell the debt. The original charge-off and a related collection may both appear, but the same debt should not be represented as two separate amounts currently owed to two companies. Medical debt has special reporting policies in 2026. The three nationwide bureaus previously removed paid medical collections with initial reported balances below $500, and medical collections less than 1 year old. A broader federal rule intended to remove medical debt from credit reports was overturned by a federal court in 2025. Do not assume all medical debt is legally prohibited from appearing in 2026. Verify the account using the current bureau policies and law. Before paying an unexpected medical collection, ask the provider and insurer for itemized records. Confirm that insurance adjustments, financial assistance, charity care eligibility, and billing corrections were applied. A medical billing error should be resolved at its source, as well as disputed on the credit report. Hard inquiries have less influence than payment history or utilization, but repeated applications can still create risk. Apply only when the account is useful and affordable. Pre-qualification that uses a soft inquiry can help you compare possible offers before submitting a full application. FICO models generally group certain mortgage, automobile, and student loan inquiries made during a focused shopping period. Depending on the model, the window may range from 14 to 45 days. Keep rate shopping concentrated instead of spreading applications across several months. Credit card applications are not normally grouped as rate shopping. Applying for several cards in 1 week can create several separate inquiries and new accounts. Checking your own report or score does not create a damaging hard inquiry. Monitoring is part of responsible credit management. Review your reports after disputes, major payments, account changes, or suspicious activity. Freezing your reports can prevent accidental and fraudulent applications. Keep the credentials needed to lift each freeze in a secure password manager. Do not leave reports unfrozen simply because you expect to apply for credit someday. When planning for a mortgage, avoid unnecessary credit changes. Do not open or close accounts, finance furniture, co-sign a loan, or run up card balances without consulting the loan professional handling the application. Lenders can recheck credit and financial obligations before closing. Co-signing is not merely providing a reference. A co-signer becomes legally responsible for the obligation, and the account can affect both parties' reports. A late payment by the primary borrower can damage the co-signer's credit. Bankruptcy, foreclosure, repossession, and serious delinquency do not make rebuilding impossible. The formula remains the same. Confirm that discharged or closed accounts are reported correctly, prevent new late payments, control revolving balances, add only manageable positive accounts, and allow time to pass. Accounts included in bankruptcy should not continue showing new amounts past due as though payments are still required. They may still retain accurate historical delinquencies and the bankruptcy notation. Dispute inaccurate post-bankruptcy balances or statuses with evidence from the court and creditor. Do not borrow at extreme interest rates simply because a company claims the loan will rebuild your credit. A product that creates another unaffordable payment can make the damage worse. Credit repair must improve financial stability, not sacrifice it. The same principle applies to credit repair companies. No company has a legal power that consumers do not have. A legitimate organization may help organize documents, explain rights, or manage communication, but it cannot guarantee deletions of accurate information or promise a specific score increase. Federal law prohibits credit repair organizations from demanding payment before completing the promised services. Consumers must receive a written contract describing the services, costs, timing, and cancellation rights. A company demanding immediate payment, telling you not to contact the bureaus, or guaranteeing a new score should be treated as dangerous. There is no secret Section 609 deletion loophole. Federal law gives consumers the right to obtain information about their credit files, but it does not require bureaus to delete accurate, verifiable accounts merely because a letter mentions a particular section of law. A credit sweep usually refers to mass disputing negative information, sometimes with false claims that every account resulted from identity theft. Filing a false identity theft report can be a crime. Legitimate identity theft protections are for actual victims. A credit privacy number, or CPN, is not a legal replacement for a social security number on a credit application. Numbers sold as CPNs may be stolen social security numbers, including numbers belonging to children. Using one can involve identity theft, bank fraud, or making false statements. Creating an employer identification number does not create a legal second personal credit identity. Business and personal credit serve different purposes, and a business structure cannot be used to hide personal fraud or escape legitimate obligations. Avoid companies promising instant deletions, guaranteed approvals, fake primary trade lines, new credit identities, or perfect scores. Real credit repair can be powerful, but it is not magic. Your recovery plan should begin with stabilization. During the first 24 hours, list every debt, balance, minimum payment, interest rate, due date, and account status. Stop new late payments by setting reminders and automatic minimum payments. During the first week, download all 3 credit reports. Mark every suspected error and identity theft warning. Freeze all 3 reports if you are not actively applying for credit. Contact creditors about accounts that are at risk of becoming late. During the first 30 days, submit well-documented disputes. Bring manageable past due accounts current. Establish written arrangements for obligations you cannot immediately cure. Begin paying down highly utilized cards. At the same time, build a small emergency buffer. Even a few $100s can prevent a car repair, medical copay, or interrupted paycheck from becoming another missed payment. Credit repair without emergency savings remains fragile. During days 30 through 90, monitor dispute results and verify corrections. Continue lowering revolving balances. Do not replace available credit with new spending after every payment. The balance must stay down long enough to be reported. If your reports contain no active positive accounts, consider adding one carefully selected secured card or credit builder product. Do not open both unless the payments and fees are easily affordable. By 6 months, the goal is not a particular score. The goal is 6 consecutive months without a new late payment, falling utilization, resolved errors, controlled applications, and a working financial system. By 12 months, you should have a full year of current positive behavior. Some negative information may remain, but its age has increased while new positive history has been added. This is how a damaged file becomes a recovering file. Someone with $500 of debt and someone with $50,000 of debt use the same credit principles. The amounts change the repayment timeline, but the scoring priorities remain accurate reports, on-time payments, lower revolving utilization, careful account management, and time. If you have a small amount of card debt, eliminate high utilization quickly while preserving your emergency buffer. If you have large card balances, contact creditors about lower rate options and use a structured payoff method. If you cannot afford minimum payments, The problem is larger than score optimization. Protect housing, food, utilities, transportation, insurance, and essential medical care. Contact creditors and a reputable nonprofit credit counselor before accounts spiral further. A nonprofit credit counselor may be able to create a debt management plan in which eligible unsecured creditors reduce interest rates or fees. Understand the monthly payment, length of the plan, account closing requirements, and total cost before enrolling. Debt settlement is different from credit counseling. Settlement companies may ask consumers to stop paying creditors while accumulating money for offers. This can lead to additional late payments, collections, lawsuits, fees, and possible taxes on forgiven debt. Evaluate the risks carefully. Bankruptcy is a legal tool, not a moral failure. For people who cannot realistically repay overwhelming debt, consulting a qualified bankruptcy attorney may be safer than draining retirement savings, falling behind on housing, or paying years of fees to an ineffective settlement company. The best decision is not always the decision that produces the fastest possible score increase. Sometimes closing a dangerous account, seeking hardship relief, settling a debt, or filing bankruptcy protects your long-term financial life even if the immediate score effect is neutral or negative. Credit exists to serve your financial goals. Your life should not exist to serve a score. Monitor progress using reports, not only numbers. Confirm that balances are updating, payments are being reported correctly, and disputed errors have not reappeared. A score can move for many reasons, but the report reveals the underlying changes. No legitimate expert can promise that paying a particular amount will create an exact number of points. A person with one maxed-out card may experience a different change from someone with collections, a thin file, or several late payments. Your score may improve quickly after a major utilization reduction or correction of a serious error. Recovery from legitimate delinquencies usually requires more time. Both types of progress are real. The final formula is simple, even when the work is difficult. Pull all 3 reports. Correct factual errors. Stop new delinquencies. Bring accounts current when possible. Lower individual and total card utilization. Avoid unnecessary applications. Keep useful older accounts open when appropriate. Add only affordable credit-building accounts. Protect your identity. Reject fake loopholes. Repeat the process every month. Credit is not fixed by paying a stranger to send aggressive letters. It is fixed by controlling the information and behavior that scoring systems measure. Every on-time payment replaces chaos with evidence. Every reduced balance lowers risk. Every corrected error makes the record more truthful. Every month without a new mistake creates distance from the past. Your current score describes a financial record. It does not decide your future. Start with the report, follow the evidence, protect every due date, and give your new habits enough time to become your new history. If you enjoyed this content, please share and subscribe.